2.25%. Joining us is Jack Micenko. He's a home builder analyst with Susquehanna Financial Group. It's good to see you today, Jack. What stands out with you in this report?
The beat was driven by top line. So they sold more homes at a little bit of a higher price. The other thing that stands out, unfortunately, is the profit margins were lighter than expectations. Gross margin in particular, and they also didn't leverage their cost basis on the G&A side as much as we were hoping for.
You know, you surprised to see the shares jump to the upside then?
I am a little bit, yep. Yeah, we downgraded the shares back in mid-October, partly on valuation and partly because of our concern directionally on what margin would be this, into 2020.
They're talking about guidance here, first quarter deliveries of between 1,650 and 1,850 units with an average price of between 800,000 and 820,000.
Right.
I thought all the room in this market was at the entry level.
A lot of the demand's at the entry level. A lot of the pricing power is at the entry level. You know, Toll's going to build, let's call it 8,000 or 9,000 homes next year. That's about 1% of the new home market. So there's always a niche. The question is, can they follow that demand downstream? Can they move off the coasts where they're the strongest, like in California and the Northeast? And that's higher margin deliveries for them, and continue that success into the middle parts of the country.
The margin pressures that you see in this report, is it a macro story? I mean, in terms of just overall industry costs going up, or is it something else?
I think for Toll, it's more specific to them. I think it's segmentation. California, their margins are, so Toll reported a margin of about 19% this afternoon. Their California margins are in the mid-20s. Margins in other parts of the country, call it Texas, Florida, they might be in the mid-teens. So as you shrink California had a rough go a year ago, and the Northeast is slowing, that's no surprise. As you retrench into where demand is better, both in geography and in price point, you lose some of that margin benefit. I think that's part of it. Material costs have stabilized some, labor has stabilized some. It's not the conversation point with these companies that it had been. So I think this is more of a mix on their footprint on their own.
How closely are these home builders paying attention to what happens with the China trade deal?
I think it's more of a confidence issue and noise than it is,
Why? Because they've already adjusted to what the tariffs are on materials?
I think you more worry about tariffs out of Canada for like lumber, say, than you do, a lot of stuff from overseas and from China. And then labor is obviously a bigger input than materials when you're building a home, and obviously, that's built with a domestic workforce.
Are you constructive for the